In this video, I'm covering some of the typical trade-based money laundering techniques that you should be aware of if you are working or if you are starting your career in financial crime prevention and anti-money laundering. So let's get right into today's video. Hi and welcome to FinCrime Agent. I'm Marco Beranzoni and this is my YouTube channel where I'm talking about financial crime prevention and anti-money laundering related topics. As mentioned in the intro, I'm giving you today a drill down about known trade-based money laundering techniques to help you refine your TBML knowledge. So without further ado, let's bring up some slides and look into trade-based money laundering techniques. So let's start with the definition of trade-based money laundering. This is a definition that I got from the guidance from FATF named Trade-Based Money Laundering, which was published back in 2006. This may sound a bit dated, but the definition is very much applicable and is in line with what today would be considered trade-based money laundering. So they are saying that trade-based money laundering is defined as the process of disguising the proceeds of crime and moving value through the use of trade transactions in the attempt to legitimize the illicit origin. In the next slides, I will cover some basic techniques and one example for a complex technique. Out of the basic techniques, you will find out more about over and under invoicing, multiple invoicing of goods and services, over and under shipments of goods and services, and falsely described goods or services. For the complex technique, I will discuss with a practical example the black market peso exchange. So over and under invoicing, this is one of the oldest methods of fraudulently transferring value across borders and remains a very common practice even today. Invoicing below the fair market price will allow the transfer of illicit funds from exporter to the importer. The importer will be able to sell on open market at a higher price and retain the extra profit. Invoicing above the fair market price will allow the transfer of illicit funds in the other direction, from the importer to the exporter, and in this case the exporter will pay an amount in excess, allowing the exporter to retain the extra profits. Let's look at a couple of examples of over and under invoicing. So you can see we have an importer and an exporter as part of this picture. The importer is buying items from the exporter, which on the fair market value the cost would be $20,000, but instead the exporter is invoicing the importer for only $10,000. So once the importer will sell the goods on the open market, there will be a difference of $10,000, and therefore once the goods are sold, the $10,000 extra have been illegally exchanged between the two parties. Let's now look at over invoicing. In this example, you will see that the transfer of money is going in the other direction, from the importer to the exporter. So in this example, we've got an importer buying a volume of goods which on the fair market the value would be $20,000, but instead the exporter is over invoicing the importer and sending an invoice for $30,000 instead. So by doing this process, once the exporter covered the goods production cost, the additional $10,000 have been illegally exchanged between the two parties. With these two examples in mind, some other notes and considerations are that none of these would be possible unless both parties, importer and exporter, agrees to commit trade-based money laundering activities. It is also possible that both companies can be part of a larger parent company. There will be tax implication in both examples, hence tax fraud could also take place. Under-invoicing appears to be widely spread, also because custom agencies are often more focused on the import side to stop contraband and ensure the appropriate duties are collected. Complex transactions are gonna play a key role in here as well, as they make it very hard for custom agencies to identify the fair price and spot any under or over invoicing. So let's move into the other technique, multiple invoicing of goods and services. In this case, the exporter invoices multiple times the importer for the same order. Invoices are often sent to different financial institutions, making this laundering technique more complex to be identified. When multiple invoicing is detected, legitimate explanation can also be provided by colluding parties. Those includes maybe the payment terms have been changed. They can say that correction to the initial payment instructions have been done, or maybe a late fee payment is part of this additional invoicing. So let's check one example of multiple invoicing so we can get more into the details of this technique. So in this case, we've got the exporter and the importer. The order value is for $30,000, and we can see that a number of invoicing have been issued to different accounts, probably correlated to different financial institutions of the importer. All the invoices could be for the same figure. For example, the order is $30,000, and once those are paid, you can see that the exporter would have received 3 times the actual order value from the importer using this trade-based money laundering technique and using the same trade. Let's move to another example of basic techniques for trade-based money laundering. This one is over and under shipments of goods and services. In this example, colluding importer and exporter can understate or overstate the volume in the trade order, and by doing so, the exchange of lower or greater volumes of goods can facilitate money laundering activities. In some extreme cases, goods are not shipped at all. Those are called, in fact, phantom orders. So the last example of basic trade-based money laundering technique I want to cover is falsely described goods and services. This practice implies the use of false statements for the type of goods that are shipped. For example, sending inexpensive items and claiming for those to be luxury items. This can also be applicable, obviously, to services, not just to goods. But let's check one example of these trade-based money laundering techniques, and then we can move into the complex example. So we've got in the picture again our exporter and importer, which are colluding to commit trade-based money laundering. The goods that have been declared being exported are watches. However, once they are actually sending items, they are not going to send watches, but sending with a much lower value, for example, like small plastic gadgets. So the value discrepancy based on the falsely described goods or even services, if you would swap these goods with specific services provided, would allow the importer to illegally transfer extra funds to the exporter. So that's the end of part 1 of my video. If you want to find out about more trade-based money laundering technique, check the link right above where we will continue the discussion about this topic. I hope the information that I shared are useful, and if you have enjoyed my video, remember to subscribe to FinCrime Agent and press the bell so you can get notified as soon as new videos are going live on my channel. Remember to check the description of my video to find some useful links and references, and in there you will also find my patreon.com page where you can support FinCrime Agent on patreon.com. So we are at the end of the video. Thank you for watching, and until next time, see you soon.